It's 9 o'clock here, so we'll go ahead and get started. My name is Dale Latz. I'm a farmdoc associate here at the University of Illinois and also have an affiliation with Illinois Farm Business Farm Management Association. Joining me this morning is Brad Zwilling. Brad is Vice President of Data Analysis for Illinois FBFM. This might be the first webinar that Brad's been involved in, I think, possibly with FarmDoc webinars. What we're going to be talking about today is looking over the 2019 results from the Farm Business Farm Management income record summaries. This is the first year we've done a webinar on this, so we're real glad to get here and present some of the results in some interesting times we're in right now, that's for sure. As we kind of look back, and I'll turn it over to Brad here, first of all, just to give us a little background of where the information, more detail of where the information comes from.
Yes, thank you, Dale. Like Dale said, this is my first FarmDoc webinar. I've been writing articles for many years for the FarmDoc team. But the data here comes from farms that are enrolled in the Illinois FBFM Farm Business Farm Management Association. These farms are throughout the state. And we have about 5,500 farms, and about half of those are certified usable by the field staff that work with them. So there's a certification process that said those numbers are good, accurate information, and we use those in the averages to put together some information to use to help make projections for next year, help our farmers use for their planning purposes. So I'll turn back to Dale.
So as we get started here, and again, this goes back to 2019 record results. That seems, with all that's happened this spring, with PPP and CFAP, all those things going on now and everything in between, it seems like this has been a couple of years ago already, but it's only been 5 or 6 months ago since we ended 2019, and usually the results are summarized in the March, April time period. So that's not that long ago, but it seems a lot longer than that. As we just kind of look back to last year, was a very challenging year. 2020 starting out to be a very challenging year also, but obviously record rainfalls, a wet spring, late planting, and all those type of things that got us off to a very slow start across the state. Some areas we did have prevent plant acres. That's pretty unusual in Illinois. We had some prevent plant acres in areas we don't usually see that, so that came into play. With the late planting, obviously some higher drying costs for corn. That might have ranged $30 to $80 an acre or so is for the additional drying costs, especially in northern and maybe central parts of the state. So that was an added cost that we normally don't have. With the late planting and the challenges, we did see lower yields, especially probably in the northern part of the state. They still were not bad, but they were lower. The NASS yield figures for the state of Illinois, we went from 210 bushels an acre the year before down to an average of 181 bushel per acre statewide for 2019. On soybeans, we dropped, pretty good drop from an average of 65 bushel an acre in 2018 to 54 bushel. That was the lowest yield and bean yields since we had in 2013 when it was 49 bushel per acre. So we did have lower yields, not like a drought year necessarily, but from what we had been used to the last 4 or 5 years, we did see a decline there. And then obviously some information or some government support that helped support incomes. We did have a second round of MFP payments that occurred last year. 75% of that was paid, 50% I believe in August, another 25% in the fall, and finally another 25% after the first of the year. So that was important in supporting farm incomes as a result of some of the tariff issues we had and drop in exports and so forth, especially soybeans to China. So that did help support farm incomes and was very important. But again, as we look back, a very, very challenging year.
Yeah, and Dale, with that information that Dale provided us, now let's look at what the accrual net farm incomes have happened. So the 2000 net farm income really dropped. We went from 2018 was about 138,000, almost was cut in half down to 71,000 in 2019. That's a huge drop. That's still a decent number. It's still close to our 5-year average of about $67,000. But, it's a lot lower than those high years we experienced back in 2011 and 12 and those type of periods.
When we talk about net farm income, that's an accrual-based net farm income. So that's basically the profit from the farm. Does have depreciation subtracted out of it, but it is accrual-based figure as compared to a cash-based figure, which most farmers file their income tax on.
And then in 2019, where the incomes were at the highest were in the central and eastern parts of the state. That's where they had the less rain, the less prevent plant acres. We saw the lowest incomes in northern Illinois. We had the largest number of prevent plant acres, and then just a lot of late planting, so lower yields there as well. So that's where we saw the lowest is in northern Illinois, but the income was the highest in central and eastern parts of the state.
One of the things as we talk about incomes, we look at our gross per acre on grain farms. Most of these farms are grain farms, of course, in Illinois, but we do have livestock farms. One of the measures we look at is what we call crop returns. That's basically our gross value of our crop produced per acre, again, on an accrual-based figure. You can see in 2018, that figure was $780 per acre. That dropped $55 an acre down to $725 per acre in 2019. Again, think of that as your yield times price, basically, and any value of inventory changes. But also that comes in there as we do include crop insurance payments, government payments like the MFP payment, which was important, obviously, in 2019, that averaged about $60 per acre or so, as far as that standpoint. So that's of that $780, around $60, or excuse me, $725, about $60 an acre is MFP payments. So that's a significant part of that. So that was kind of one of the underlying and biggest factor in our drop in incomes was our drop in our yields, which resulted in the drop in the crop return figures. As I mentioned, the MFP payments were an important part of incomes last year. Last couple of years, and looking ahead to 2020, that looks like it's going to be the same thing. The average FS payments on a total basis per farm was a little over $64,000. $64,115 per acre was the measure of that FS payment. And we're talking about a $71,000 figure for net farm income. So one way to look at that is about 90% of our net farm income came from that MFP payment, crop insurance, government payment, FSA payments. If we didn't have that, we'd be down to about a $7,000 net farm income, just about break even. So again, a very important part of that, and as listed at the bottom of the slide, the FS payments include mainly the MFP payment last year, but also any CRP payments on some farms, if there was some livestock payments also. So again, a very important part of the total net farm income.
So looking at accrual net farm income that we've talked about, now looking at it over a 10-year picture, and then comparing that to what we look at is called labor and management income. The difference between the two is taking off a charge for interest on equity. So the piece of the assets that we own that are free and clear, our net worth piece in essence, and putting a charge on that to, it's kind of an opportunity cost in essence as a number. So if we invested it somewhere else, that's where it would be. And as well as taking off a charge for the unpaid family labor in the farm. So that's what's left to pay for the operator's labor. And that would be the work that they did with their back. And then also their mind as far as the management skills and ability. That's what's in the yellow there. So as you look through things, the 2012 was our highest year for net farm incomes. That was $298,000. Then the labor and management income was $235,000. And then we go down to the low of 2015, which was a year of a negative accrual income. If you look at that over the time period, we haven't really had a low number like that, even over a longer time period. And then comparing 18 and 19, you see that we go from 137,000. That's that 48% drop. And then looking at the difference between the two, you're looking at almost a $60,000 difference, and that would be the charge for the unpaid family labor as well as the interest on equity capital. And then, so if you look at this time period, that average net farm income has been $134,000, so very close to what 2018 was. But if you look at the period from 2013 to 2019, you realize that's not where it's been. It's closer to that, probably that $70,000 to $75,000 number. So there's some interesting chart to look at. And then this is not adjusted for inflation. And I think Dale will point that out here in a second.
Sure. The next chart as we move forward, kind of a similar measure, but just over an extended time period. Again, we're looking at operator share of labor and management income. And this is adjusted for inflation, with the 2012 year being our base year, in terms of that equal 100. And just kind of a little history lesson here. If we go back into the 70s, when we started this 72, 73, I guess I would have been around in college then, if I remember right. But what was going on then? We had a couple things like the Russian grain deal when we started expanding our exports out of this country. And also one of those years we had a blight on corn that prompted up grain prices quite a bit. And until the 2007-12 time period, actually our highest incomes that we had as we adjusted for inflation would have been back in the early 70s. Then that kind of fell down during the 70s, and a lot of us remember the 80 period where we just had excess supply, surplus, more government payments, just dropping our exports and so forth. Incomes dropped a lot with that 1980 to 85 period, especially being pretty financially a tough time period. Kind of a increase in farmland prices before then about a 50% retrenchment during that period, and kind of slowly going upward in the 90s and the early 2000s. Then we had that 2007, 2012 time period, and has pink background there with very high incomes. We did have a drop that one year in 2009, I believe it was, when we had a drought and lower crop yields. But other than that one year, we had very high incomes during that time period. And that was kind of the bringing on of ethanol production, which used a lot of our corn production in this country, that raised corn prices, along with the expanded exports to China with soybeans and so forth. That really improved our crop prices. Since that time frame, the 2007 through 2012 period, after that now, and kind of our current situation, we're dropping back down, as you can see there with our farm incomes. We've had good production, building up surpluses. Ethanol use has been flat now for a number of years, so we're not expanding the use of corn from that market. And then also we've experienced obviously increased export competition from South America, especially on our soybean crop. So we've seen kind of a drop in commodity prices, corn, soybean prices, good production, and so forth. That's resulted in the lower farm income. So that's kind of where we're at there. We've seen a little bit of improvement the last couple of years, but still at pretty modest levels as far as farm incomes. In the last 2 or 3 years now, we're seeing the government kind of getting in and helping support farm incomes with some of the tariff situation, and now with the COVID-19 issue and things like that, that's put continued pressures on our livestock and commodity prices. So kind of a good historic view there of what's been going on over the last, 40, 50 years or something like that to put things in perspective.
Yeah, and on that, we get the highest highs and the lowest lows in the last, 10 years, Dale. So it's in actually 15 years. So it's been, we may have some periods with some real high income. We also got some of the lowest years. It's not as level as it was in the 80s through the 2006 time period.
It does show you much more variability since 2007 than what we had the previous 10 or 15 years before then.
So on this slide, we're still showing the net farm income, accrual net farm income for the whole state, but we're trying to break this out. In Illinois, we all know there's a lot of grain farms primarily, and as you see on this graph, the dotted line is the number we've been talking about so far. That's been that net farm income for all farms in Illinois. The green line is the grain farm, so you can see how closely correlated those two numbers are. And that number for 2019 was 73,000. It was like 71,000 for all farms. So you can see how closely related that is. And then you get into the different livestock enterprises, and livestock, these farms don't have any grain. To be a livestock farm in Illinois, you at least have to have 40% of your crop returns fed. So a beef farm could have quite a bit of grain farms, and that's why they still kind of follow the trend of the grain farms, but they also have a large percentage of livestock on those. So if you look at the differences in there, you see the beef farms there, they've had gone way up in 2017 and kind of leveling back off. Beef farms really are very cyclical in their incomes. And dairy farms have just been staying right around that zero number for a long time, and then dip up and dip down. So we saw a bump up in 2019. I don't think as we look forward for next year, I think the livestock farms are really going to have a tough year in 2020. And then hog farms had a little bump up as well. They kind of followed the dairy as well. So you look at those incomes, they're still positive. They're still in that number. I wish I had that number, how much that was the FSA. We know the hog farms had MFP payments and the dairy payments did, but the beef didn't. And that's some of the difference there as well. That's why we see a little bit of that dip in 2019 from the beef farms compared to the dairy and the hogs. If you look at this for all farms, that 5-year average was 67,000, as I talked about. And then the average for all farms was 71,000. But the livestock is a lot more variable. You can see the years that, those grain prices, we didn't go back 10 years, but if you looked at that where the grain prices are really high, the livestock farms were really low because they're paying that high expensive feed. And you're still seeing that in 2015 where, they were really hit hard. They went way down to the bottom there, the beef and the hog farms did, and the dairies kind of stayed around zero.
Yeah, so again, you can see there the 2019 average in all farms was 71,000 on our accrual net farm income basis, and then actually a little above the 5-year average. But as Brad said, a lot of variability from year to year among the different types of farms. So at this point in time, we've got one poll question here for you to answer. You've seen what we've kind of talked about in the last few minutes here in terms of what farm incomes have been. Obviously, 2020 is turning out to be a pretty challenging year also as we get started here. We started planting pretty early in a lot of areas of the state. Then we've had rain and kind of slowed things down a little bit, but we're still planting progress is going along good. Although the cold, wet weather has slowed kind of the growth of those crops going on. Then, of course, we've had the COVID-19 thing, which put just everything up in the air and dropping commodity prices and so forth. So as we look for 2020, we'd just kind of like to get your opinion on what you think farm incomes, again, accrual net farm incomes will be for Illinois grain farms. We've got the 4 choices there: less than zero, 0 to 50,000, 50,000 to 100,000, and greater than $100,000. Again, this would be accrual net farm income per farm on grain farms. So if we want to take a minute here or two, and if you want to kind of give us your opinion on where you think farm incomes will be for this year.
Yeah, and Dale and I were trying to figure out where this would be and where they are, and with the unknown of what government payments still might be out there. So,
yeah, I think there's obviously some things have happened already, and with the CFAP now going on, and who knows what'll happen in the fall. But.
And the WIP Plus program as well. That was some money that's came out that was established, but didn't realize it kind of opened up to farmers for 2020, for 2019.
Right. So. Here's the results. So I guess, Jim, we're good enough to go on the results. It looks like 13% are indicating less than zero. 0 to 50,000 is the winner here of 62%. 50 to 100,000, 25%. Nobody at all is looking over 100,000. So that's probably pretty accurate here on where we might result or end up here. But a lot of time to go here. We're just in May, starting June. So we'll see what happens. A lot of variability is going on out there. Okay, as we move ahead then, this chart shows some trends going on Illinois grain farms over the last 5 years. Again, just a little bit of background. These are just grain farms. We pulled out 4 or 5 different areas or factors and just see how that's changed in the last 5 years. Just as a basis of understanding kind of crop rotation here in 2019, about 50% of the crop, the land was in corn production, 42% in soybean production, and 8% in other production, which would be wheat, specialty crops, seed corn, hay, things like that. So you can see we talked about yields being down in 2019 from the previous years. We're coming off 4 or 5 years, 6 years of really generally good yields, especially increases in soybean yield. So we did see a drop off in 19 with the weather conditions we had, but considering that and the late planting we had, still pretty decent yields, 194 bushel average on all grain farms in the record system here, 59 bushel on beans. So a drop off about 10 to 13%, 12 and 13% respectively on yields. That did, as we talked about, drop our crop returns. Again, crop returns are for the most part a function of yield and prices. Actually, when we closed the records, it's hard to think about that today, but we had higher soybean and corn inventory prices at the end of 2019 that we closed our records with than we did at the beginning of 2019. Now, soybeans kind of dropped off after the first of the year, but actually prices on inventory at that point in time were higher than the beginning of the year, but we did have the drop off in our yields. And again, the $60 or so per acre would be in that figure as far as the MFP payments. Our crop expenses, the big three there, fertilizer, pesticides, and seed. You can see what those total over the last 4 or 5 years, fairly steady. The bigger driver in that in terms of any variation is fertilizer. Pesticides and seed do not change a lot from year to year. Fertilizer does have more variability. So that's kind of the indicator there of the changes, a little bit of an increase last year in those crop expenses. Machine repairs, fuel and hire, other direct cash costs there, you can see total of $75 to $80 per acre. Have had kind of a continued increase in some of those a little bit. Fuel shouldn't be a little probably maybe a little drop off this year in fuel costs. Total non-feed costs are kind of our total cost of production then, which include some of the economic charges. So that includes our operator labor and interest charge on equity besides cash costs, other overhead costs and things like that. You can see again on an economic analysis, the management returns would be kind of the economic basis or profit, if you will, measurement. And you can see we didn't cover all our economic costs for 2019. We didn't in 2017 or 15 either, as far as that goes. That simply means if it is a negative figure, when we look at our cash costs of production plus our economic charges in terms of our labor charge, unpaid labor charge, our charge on our land use and things like that, we're not kind of generating the gross to cover that. The bottom one we kind of show in there is just kind of interesting in terms of capital purchases towards the bottom, just to see how much per acre our farmers spending on new capital purchases. Just want to point out what happened in 2018 and 19. That's basically due to the tax law change that occurred. In 2018, the rules were changed, and when we had trade-ins, before we just simply showed the cash boot as kind of our capital purchase, or outright purchases would be the cash. 2018, that was changed where the value of that trade-in had to be shown as a sale, and obviously that value of the trade-in then was also included in the cash purchase. So we didn't see that much of an increase in purchases in 2018 and 19. That was more of a tax law change, which resulted in kind of an accounting change in how we handled those transactions. Total net farm income, that figure there for 2019, 92,000. That's a little different than the 71,000 we've been talking about, just because this is simply grain farms, does not include the livestock farms. And so you can kind of see the variation we've had across there, but about a 50% drop in net income from 2018 as far as grain farm production.
And Dale, our grain farms that are a little bit of the larger group, we kind of separate some of those smaller farms that have a little bit more going on. So these would be the farms that are a little bit larger. That's why it's still a little different too.
Yeah, these over 500 acres. Yeah. That's right. So not only are these grain farms, but over the 500 acre size. So we kind of take the data and slice it 2 or 3 different ways from time to time. So again, that kind of gives us a little bit of an idea of some of the trends that are going on. And these are farms, grain farms across the whole state, central, northern, and southern Illinois.
Now we look at this a little bit different, what Dale had talked about. Now we're kind of breaking those returns up or those costs up for corn and soybeans in 2019. So we're looking at there's where we talked about those percentages that Dale was talking about, the 50 to 43% in land and crop. And then looking at soil fertility, that's 146. You can't really tell what that number is compared to last year, but that was a 14% increase on the corn cost. And the soybean cost was up fairly similar to that, not quite as much. We don't use as much we don't use any nitrogen in producing soybeans. Pesticide costs and seed costs were very similar to 2018. And drying costs, as we all know, we've talked about that, went up a bunch, and it went up 69%. So when you put all those together, you're looking at total variable costs of $420 an acre for corn and $214 for soybeans. The total other costs would be some of those economic costs. It would be the labor. It'd be the repairs, fuel, oil, depreciation, economic depreciation. So you add that in, you get a total non-land cost of $674 for corn and $434 for soybeans. You add in the land cost. The land cost is a number that's a hybrid number. It's taking the percent owned, percent cash rented, percent crop shared, and looking those different economic costs to farm those operations or to farm that land and get a blended number. And that's where we come up with about $216 was the cost in 2019. And we just split that in half and call that the same for corn and soybeans. And then so the total all economic costs would be $890 for corn. Last year, that was $863. So you can see that it was primarily the increase in the soil fertility and drying. And then soybeans were about the same. It was $650 in 2019 to $645 in 2018. So that stayed about the same. And then you look at the yield per acre for 2019 for corn and soybeans, you have 194 and 59. So you divide that total cost, a total non-land cost, by the yield per acre, you get $3.47 to cover that cost on an economic basis that you'd have to get. And then soybeans, $7.31. And then when you look on all costs per bushels for 2019, it would take $4.58 to cover that, those costs, those economic costs on that farm, and then $10.96 for soybeans. For comparison, for corn, that was $3.90 for 18 and $9.43 for 2018. To kind of get rid of those variances in yield, because we know that cost per bushel is going to be vary a lot by yield, and we know there was a big change in yield from 2018 to 2019. We kind of look at a 4-year moving average of yield. So that would give us $2.12 for corn. And if you use that over the total cost, now it comes a little bit lower at $4.20, but still that's a high cost or a high dollar per bushel that we really can't get as far as just in the grain price when we sell the grain. And soybeans was $10.16. So I've got a couple graphs here to kind of show those same numbers now over time at a 10-year window. And so we're looking at this. The bottom part is non-land cost, and then the top part is the land cost. Remember, that's the kind of the combination of owned. And when we look at owned, that's kind of the real estate taxes and the interest charged on owned land. And then the crop share, that's kind of the cost to run over acres that we don't receive revenue from. And then with the cash rent is the actual cash rent paid. So when we look at that, that's on top of the non-land cost. So that gives you the total cost. And then we show just the price received. Now, remember, this is just the average price received for all Illinois farms from in that time period as it goes through time. But you got to remember, there's other things that are not included in that. We don't have crop insurance. We wouldn't have any government payments. We wouldn't have other income or any custom work, for instance, that farm operation might supplement their income with in this trend. But at least you can look at that dollar per bushel and see where the things are. So for the highest year in 2012, we kind of talked about that already. We've got that $7.51 was our total cost. Even in that time frame, we were a lot. Costs were, 70 cents higher than what we were price received. And then we know there wasn't any government payment, or it wasn't in government payments there, but we had crop insurance that would have filled that difference up. And then go to 2019, you see that big difference. So we're, in those timeframes, we're really not covering all our land cost with just the price received. There has to be other things we'd have to look at in that window. And then looking at this for soybeans, looking at those two charts, you see that the price received line, that green line is in the gray and the land cost in the corn. But with soybeans, we see that it's pretty much either right at or above. And that's what we've seen in the last probably 5 to 6 years. That the soybeans have been a higher producing crop. It's not high producing, higher net revenue crop than corn. And that's why we've seen a lot more corn or soybean acres being planted. This is the same type of chart. You can look there in 2012, the average price received was above all economic costs. And that's what we're trying to strive for over the long term. We want those economic costs to be equal to kind of what the crop returns would be that we have for the farm. And then in that 2020 time period, we had the $13.03 for the total cost. And looking at 2019, we went back down to $8.96 was the average price received, with the total cost of $10.96. So we're hoping, if that holds true, or we want to break even, that this is going to wash out, but not with kind of the expectations for 2020. I don't think we're going to see that come back up to that level, Dale.
Yeah, thank you, Brad. So we've kind of talked about incomes. We've talked about cost of production a little bit. Let's kind of move into what's been happening from kind of the balance sheet or financial standpoint of these farms. Obviously, net farm incomes are drivers of what happens on the balance sheet, and increases or decreases in net worth and things like that. This chart here simply shows from a summary of the about a couple thousand FBFM farms that we have good balance sheet information on. And we're measuring this on actually a dollar per operator acre basis on the left-hand side there, margin. So it shows what the investment is in these farms. And we've broken that between kind of the standard three areas of terms of asset classifications: fixed asset, intermediate assets, and current assets. And fixed assets are our long-term assets, basically farmland, other real estate such as buildings and things like that, but basically farmland. Again, this is measured on a per operator acre basis. And when I talk about operator acres, that's simply the acres that the operator gets revenue from. So of course that's 100% of cash rent and owned ground, and then whatever the percentage of the lease is on crop shared ground. It's going to be 60 to 70 to 80% of the land they farm generally anymore is other revenue acres or operator acres. So you can see, again, think back of our income period there from the 2006 through the 2012 time period was the time period of the high incomes. A lot of investment in machinery, increasing land values, and you can kind of see the indication there of those land values. Some of that is land purchases, but a lot of that's just simply increase in land values as far as the increase in the fixed assets per acre. Since that 12, 13 time period, it's been relatively stable. We have not seen much of a drop in land values. They have dropped maybe 10, 15% over the last 5 or 6 years, but considered what's happened in in farm incomes, that's not bad. It's been generally pretty stable to slightly decreasing here the last few years. Intermediate assets, again, most of that's going to be the investment in the equipment, farm machinery, some retirement accounts and things like that would be classified in there. Did have quite a bit of reinvestment in machinery when we had the good income years, and still are having some of that. That's kind of leveled off there from that standpoint as far as how much is in our intermediate classification then. And finally, then the current assets. Be kind of the what's liquid here in the next year or so, be your grain inventories, cash, market livestock. Prepaid expenses would be a large part of that at the end of the year for some farms, to give us an idea how much has been in there. And we do see a little bit of a slight decrease in terms of our current assets, stable to slight decrease over the last number of years. So it kind of gives us an idea of where those asset classifications have been and the makeup of the farms. Again, agriculture is a pretty capital intensive business, as you can see by the amount of fixed assets and intermediate assets that's involved in the business. Another look, one thing, of course, that we're concerned about the last few years is the liquidity of farm businesses. Our balance sheet or net worth information, financial situation has been holding up fairly well given what's happened on farm incomes, but we are seeing with the lower profitability where we might not be generating enough profit to cover all our family needs and so forth and taxes in a given year, probably drawing down our working capital a little bit. Current ratio is a financial measure that simply divides current assets by current liabilities. The gray line there is kind of an average of all the farms that we did in this study over the last number of years. Generally, I think a rule of thumb, and it varies by type of farm and things like that, but 2 to 1 or a 2 to 1 current ratio is not bad yet. These are generally pretty strong financial farms that are in these studies. But we have seen a decline in that since those higher income years that we talk about, that period that kind of ended in 2012. You can see we're up to about an average of a 3.1 current ratio, and that's down to 2 now. So we have seen some drop off there. So what we also show in this slide is not only the average for all the farms in the study, but the upper quartile. And so the upper quartile would be that top 25%, kind of what their average current ratio is. So this would be looking at the very strong, financially strong farms and kind of getting an idea, if you want to measure to something at the top level, if you will, what are those current ratios? So you can see those are up in the 5 to 6 to 1 area. Some drop off there, as we would imagine, in the last 4 or 5 years, 6 years with the lower farm incomes, but still at a very strong level. So, the point is, not only have we had a slight decline, but on all farms, every farm is different in terms of their production capabilities, their financial situation, their leasing situation, and so forth. So you can't make blanket statements about every operation out there. They're all a little different, and this kind of gives us an idea of some of the differences out there from that standpoint.
And with that slide, Dale, it's just amazing that, we have still 25% of our group that has that high of those numbers. And when we're talking about the numbers for the financials, we're kind of looking at about the same number that we'd have for the net farm incomes. We're looking at that a little greater than half. So 25 to 2,700 farms are in our financial studies as well. So it's a bigger group. This chart talks about debt to asset ratio. When you hear people talk about my ratio and what these are, you have to realize sometimes you also need to ask a couple other questions. You got to say, well, if you said 20, less than 20% is a really good debt to asset ratio, well, what age is that person? Because it varies by age and where they're at in their and maybe not necessarily age, but where they're at in their life cycle as far as the farming operation. Maybe they just came back and started getting invested in the farm at 50. So this shows those different ranges. And I will say that the less than 30 group would probably be lower numbers than our, the 50 to the 40 to 50 to 60 numbers, because that's just not as many that, that's just, looking at USDA census numbers, most of our farmers is in that upper 50 range, the average age of the farmer. So, but looking at that, you can see how those times, the high times there, the end that, 10, 11, 12, how all those debt to asset ratios are coming out. And let me back up. Debt to asset ratio is kind of saying how much my lender has compared of my assets. So that's the percentage of all my assets that the lender has control over, basically the debt that I have on the farm. So just realizing that. So a debt to asset ratio to 20% means that of my total assets, that lender has debt on 20% of those. So, that number, and that's a good thing. We want that probably in that 20 to 30, stronger, probably stronger than 30, but it's all 30% debt to asset ratio. But all of those are fairly good in this range. And like I said, that less than 30, there's not a lot of land owned and there's not a lot of assets owned in that group. So they're going to have a very high, but they also have a lot longer time frame to be invested in that farming operation. So that's still it's a decent ratio for the less than 30. But you can see how that's increasing with these tougher times. It's a lot harder to make those payments and may have to have more debt, more operating money that they have to borrow. And you can see how that levels out as they get older and more established in the farming operation. So that, 50 plus, 60 plus ranges, they're a little bit more level. They're pretty stable in there. To have only a 10% debt to asset ratio is probably, probably not having any, it's probably just a little bit of land debt that's left, Dale. It's that you're probably not having current liabilities, no operating debt. So it's just an interesting chart to look at and realize when you hear a number for a ratio, you kind of need to ask questions of what age and then even what type of farm.
Yeah, that's correct, Brad. When I was in the bank, we did some analysis, of the different balance sheet information from our borrowers, but it is good to know that sometimes you need to go a little deeper and kind of divide that data out by, like, this is a good example of, we can't expect a 30-year-old to have the same debt to asset ratio as somebody that's been in the business for 40 years and things like that. So you got to keep that in consideration. Did have a quick question on there in terms of the number of farms in the database. It does vary a little bit, actually, depending on the type of data we're looking at. But of our income figures that we talked about at the beginning, Brad kind of mentioned about 2,500 farms were included in the summary of the data that looked at the income figures and so forth. So, Kind of moving ahead here, another financial efficiency ratio. This one is called farm operating income ratio. Basically, that's a percentage of our gross, I should say, a percentage of what the farm income is of our gross returns or gross of the business. So again, if I've got $1 of gross, that's saying 10% is income or 20% is income, operating income, or whatever that might be. This goes back to 2010. I think generally in the farming industry on grain farms would be wanting a goal of 15 to 25%, somewhere in that area, 20 to 25%. So if you got a farm that's grossing 500,000 or something like that, 20% would be $100,000. It would be about what we need anymore to meet average family living costs and things like that. So again, you can see and just another way of looking at the same information in terms of farm profitability, farm operating income, we were up in that 2010 through 12 period, which was the last 3 years or so of that high income period there. We were over 30% actually, 35% kind of peaked out there in 2011. 12 was also high, and since then we've been dropping down. Again, showing the variability. In 2015, we mentioned we kind of had almost a break-even situation, basically very little income, 1.5%. Kind of a roller coaster since then. 2019, that figure was 8% or so. So again, that's of our gross, how much is really profit of that gross figure. And so just another efficiency figure. That makes up, we look at that as far as how much of the gross goes to interest, how much goes to operating expense, and how much goes to depreciation on our machinery and so forth. And the balance is going to be this farm operating income figure. So again, just another measurement of the tighter margins we've been experiencing since the 2012, 2013 timeframe. But again, a goal we'd like to see there would probably be 20 to 25% ideally. In a normal situation, and you can see we've been operating underneath that recently.
So now we're going to take a look at our family living costs. This is an interesting study. These are farms that keep track of every dollar in and out, family living farm for their operation. This is a little bit smaller study. It's a little harder to do that, but we've got about 1,300 farms that would be in this study. So what this is showing, there's a lot going on with this graph, so I'll try to explain it. So we've got at the top is the total family living cost for each year over the last 5 years. And so the top part is the expendables, the largest portion of that's your trips to the grocery store. That's your trips to Walmart. Those are the type of trips you're making, and that's the cost in there. Then you have the medical expense. That's your health insurance, your trips to the doctor. The family living capital, that would be for buying, doing an upgrade in your kitchen, putting new floor in, putting new refrigerator in, like I've had to do over the last couple of weeks. Family, and then life insurance, and then contributions. So you look at all those pieces. Contributions make up about 4% of total family living. Life insurance and family living capital is about 6%. And then medical is about 13%. As you can see, those are pretty steady over that whole period of time. And then expendables as well in that time period, that's about 71%. It's interesting to note as your family living, that's one of the big things we've preached a lot with our farmers is to cut family living as these incomes came down from those high times in the 2007 to 2012 period. But you see that the family living does drop. If you go back, remember 2015 was a negative 2,900 some net farm income. Well, the next year they cut their family living because it's kind of a year behind because they usually sell that grain the year following the year of production. So as you look at those things, you see that where those years dipped at. So I have a feeling family living will drop for 2020 just looking at that. The white line through the middle is the net non-farm income. So most of that is off-farm income, but it could be another like a trucking entity or some other type of business at the farm or that business or that family is involved in. As you can see, that net farm income takes care of about half of the family living cost. So there's still the other half has to be made up by the farm operation. And still what's left is the green line is the income and Social Security taxes. So not only do you have to come up with about $40,000 to $45,000 from the farm for that, but you also have to come up with about $20,000 to $30,000 for taxes. So it's a huge swing, and that's why we do this study. These are always interesting conversations to have with our families as we're out having those visits to talk about family living. The final one here is I kind of just wanted to point out a little bit our differences between our top third and our bottom third for family living. These are families that have 3 to 5 in the family. So it could be a widow plus 2 kids, or it could be a husband and wife and some children. So these are what these lay out. So there's family living costs. So the difference between the high and the low is about $86,000, and that ranges from $75,000 to $85,000 depending on the year. So for 2019, I think it was about 130,000 was the top. So that would be a difference of about 80,000 would have been the top, or the 50,000 would have been the lower range. So just be aware of that there's huge swings in that. So that we were showing the averages, but that can be a big difference. It's just amazing how that when you show somebody that family living number for the first time that they've joined Illinois FBFM, they say there's no way. But you sit down and figure out how many times you go to the grocery store and what you spend, it adds up. And then just at the bottom, it just shows the difference for the net farm incomes and Social Security taxes.
So again, a lot of times we talk about averages, Brad, on things, but there is differences among every farm family out there and whatever it is. And this one just illustrates the differences in family living costs. It does vary. And, some of those costs are going to be, if you've got a couple of kids in college and things like that, if you're in that time period, obviously that adds a lot to the living costs. Okay, so we've kind of gone through our incomes, cost of production, some financial and family living information here. It's time to kind of wrap up and summarize what we've seen in 2019 and the last number of years. Again, we've been kind of an extended time period now of lower to moderate farm incomes, generally speaking. I guess we don't really see any change in sight here in the near future. Gary Schnicke puts out budgets for the next year or two and has had some webinars on looking ahead a little bit on incomes. And, with the government support, depending on what happens on yields in 2020, I think we're looking at, holding our own maybe. But again, a lot of unknowns as we're just getting started in the kind of growing this year's crop. We've had a number of years of good production the last 4 or 5 years, which for one thing has helped farm incomes, obviously, with some of these areas in the 220, 240 bushel per acre on corn and 60, 70, 80 bushel per acre on soybeans, obviously supporting farm incomes, but that has added to our supply of those crops in the inventory and so forth across the country. Kind of throw in the tariff issue a year or two ago. Obviously had a significant drop in exports, especially to China on soybeans that affected our prices. Had some ad hoc government farm programs last year too, MFP and CFAP this year. Just getting into the CFAP application period this week and how that'll happen. Dr. Cole and some others talk about a black swan event. That happens very rarely, but we had one, I guess you could call it COVID-19 about black swan event, something that's really unusual, and just kind of throw that in there, and that's affected agriculture like a lot of other industries in terms of consumption of food and the processing of meats and all those type of things. So kind of got the bullet point there. What's next? I don't know. After we've had the first 5 or 6 months of this year, I'm not sure we could have anything come out that's unusual, but we would have said that 5 months ago before with COVID-19 also. So I guess as we look at all what's been going on and just all the different factors and influences on farm and farm incomes here, we see the time as much as ever, in terms of the need for good farm records, especially with the lower farm incomes and the documentation needed for lending and other uses of things like PPP and things like that. So with that, I'll let Brad talk a little bit about FBFM.
Yeah. So when we talk about good record keeping, Illinois FBFM, that's what we do. We aid in the record keeping and farm financial management decisions. We use the information from the balance sheets, income statements, and trends to help make that decision. We're an independent third party. So when you ask us, should I buy a new piece of equipment, buy land, we're using your numbers to make that decision. We use, like I said, we use that information to provide comparisons that we can use, whether it's comparing your yield versus somebody else that's in the same area or same age as you, to family living studies, to balance sheet comparisons. We're doing that, and also showing your farm compared to your farm year over year. We meet one-on-one with our families 3 to 5 times a year usually. At least one of those would be on the farm, maybe more than one, the other times in the office. And then we have 65 staff across the state, and we call those field staff across the state, all over the state of Illinois. And so that's what Illinois FBFM is. To find out more about Illinois FBFM, go to our website, fbfm.org. We're affiliated with the University of Illinois in the Agriculture and Consumer Economics and the College of ACES. Also, if you want to find out more information, just email us at info@fbfm.org, and I will get that email, and I can put you in touch with somebody who needs to or answer your questions.
So we want to thank you for joining the webinar today. We just briefly covered some of the results from the FBFM records. We do have publications that come out later in the year with more detail and more information. Brad's puts out. FBFM does have a monthly FarmDoc daily newsletter that touches on various parts of the FBFM data, more or less, and there are other information that is available. Details and some publications that we do come out with from that standpoint. We'd like to thank all our FarmDoc sponsors here. You can see on this screen the Corn Growers, the Compere Center for Farmland Research, TIA, Farm Credit Illinois, and FS Growmark. We do really appreciate their support of the program and continuing support, and look forward to that. And again, we thank our sponsors. If you have some questions, we've got one up here right now. Go ahead and submit a question and we'll get to those. Again, you can visit the FarmDoc publications, the FarmDoc Daily. If you're not registered for that, go there to register. And again, that's part of the outreach program from the Department of Ag and Consumer Economics here in the College of ACES. One of the questions that did come up here is what data did you gather on rising property taxes? We didn't touch on that much, but obviously a lot of our operators own land, and we have the real estate tax figure on those farms that own land as far as their cost of production or the costs. And the comment there is Sangamon County doubled in the last 10 years, and that is one thing we don't talk about a lot, but with the way the assessment of farmland works in Illinois, and that's a whole webinar in itself, but we have seen the last 15, 20 years a pretty significant increase in farmland taxes. And I don't know, Brad, what you know off the top of your head?
I was trying to remember that range, and because it uses is it a 5-year or 10-year?
5-year rolling average.
So, 5-year rolling average. So we've been dropping off some of those high years. And also they changed the way it was off the median PI, which used to be each PI could move more than 10%. So the lower soil range, which Sangamon County would have some good soil range, but the lower soil range are moving a lot more than 10% across the state. So there'd have to be some look in there and see how that is. And also, with the PIs and the changes in that, it's a good question. Over the 10 years, I can see that why it was raising, but now it should start gradually leveling off because we dropped out those high years.
Yeah, we've had a cap of 10% and they're kind of catching up on the cap. But I know in the area I'm in, 20, 25 years ago, we had, it might have been $20, $25 an acre. Now we're seeing, $40 to $50 an acre on some of the better soils. So again, that's no small increase over that time period. And that's been another cost that's for landowners, whether it's a absentee landowner that rents out their ground or an operator owner of the ground. That is one cost that's also been going up steadily over the last number of years. Okay, I don't believe there's any other questions. I think we're about at our 9:53 here, so about time to wrap this up. We do appreciate, again, you attending the webinar. Our future webinar scheduled. I won't go into the detail. I believe the next one's towards the end of June, but just check in at the FarmDoc site, or if you're a FarmDoc Daily subscriber, you'll get an email notice on those. But we'll continue to have a few webinars a month or more down the road. And again, we appreciate your participation and we look forward to future events. Thank you very much.